Hi, I'm Joe Seidel, Chief Operating Officer here at SIFMA, and I'm pleased to be joined today by Michael Brauneis, Financial Services Industry Lead and Managing Director at Protiviti Financial Services, for a one-on-one conversation on climate stress testing for banks. Today's discussion is part of the SIFMA Executive Viewpoint series, which features discussions with a cross-section of experts about trends and innovations shaping the future of our capital markets. Thank you, Mike, for joining me today, and let's get started.
Thanks, Joe. I'm happy to be here and really excited to have the chance to talk about this topic with you.
Yeah, no, it's very, very timely. So beginning, the U.S. is going to trail the ECB as well as regulators in the UK and Canada in conducting climate stress testing for banks. What do you see as the key lessons learned from the work that has been done so far in other markets? And what do you think the U.S. might be ultimately doing differently from those other markets?
Yeah, great question. I think we've definitely seen a divergence of approaches across the world, but we're also starting to see some trends converge. And I think in some ways the U.S. will have an advantage being able to follow that and incorporate what's worked well and what hasn't. So a couple of things I'd say. One, I'll probably beat a dead horse on this throughout this conversation, and that's the data assumptions and data availability. And I think that's both, in a lot of ways, the most critical element to this field becoming more relevant and effective over time. But I also think it's the biggest challenge we face today. So as much as the U.S. can do to standardize the data requirements, the information that they're going to pull out of the banks to conduct the analysis, as well as then I think need to have a really robust process to validate and reconcile and make sure that what we got in from the banks is apples to apples before the analysis is done is going to be really critical. The second point that I'd make is around industry participation. So you saw, for example, the exercise that was done in the Netherlands, I think about 4 years ago now, was really more data pulled from the banks, but not a lot of involvement throughout the exercise. And that's started to change a bit as the French and now the UK models have been run. And I think clearly this is such a dynamic and uncertain field where the regulators, the industry is building and figuring this out a bit as we go along. And obviously individual participants in the industry have run their own exercises. I think having the chance for that input to be provided and creative ideas coming bottom up through the stakeholders is going to be really important to inform the regulators' understanding. And then maybe the final point that I'd make, it's interesting if you look at the global exercises, we all know and your members know there's really two critical dimensions or aspects of climate scenario analysis, and that's physical risk, so the immediate impact that a disaster is going to have on a particular firm, and then transition risk associated with things like stranded assets and changing regulatory restrictions around where we can lend and invest and so forth. And obviously, climate is unique in having a much longer time horizon than many other risks that are subject to scenario planning. But at the same time, again, there's so much uncertainty of what carbon levels look like 30 to 50 years from now, how the regulators will respond, how the economy will adapt to that. And in spite of that, a lot of the scenarios so far have really focused on those longer time horizons and more on the transition risks and not the physical risks. So I think, given both the immediate exposure that is created by things like Hurricane Ida, for example, unprecedented, at least in my lifetime, how much of the country was exposed to that, and the fact that I think we have better and more certain data on the immediate physical risks than we do the transition risks, it'd be good to see the next round of scenario exercises at least balance and give a little more coverage to the physical in the short term than some of the other countries have done so far.
So, traditionally here, the outcome of a failed stress test has typically been an increased requirement to capital buffers, and certainly have had sort of extreme events at various institutions when they fail the stress test. Do you think that's a viable solution for climate stress testing? And if not, how do you see the results impacting individual individual banks otherwise?
Yeah, I think it's definitely a unique aspect of the climate scenario analysis process that for the time being, it will be more of the macroeconomic or industry-wide impact. And I think more used to inform supervisory policy and how the regulators look at this in the field than it is that any bank is going to be required to take any specific action coming out of the exercises. And I think, again, I'll come back to data that I don't think the data that is used to conduct the analysis is standardized enough yet, or granular enough yet, or reliable enough yet to say that these are the conclusions that we're absolutely certain are relevant to any individual bank, and this is the action that that bank needs to take. And then I'd also say, even potentially when we get to that point, and you find that we'll plot the industry on a spectrum, and you're going to have a slice all the way to the right of these are the very riskiest or the most exposed banks. Is asking those banks to hold more capital actually going to be the right solution or right remedy to this? And I think, could it play a role? And certainly in terms of solvency, yeah, absolutely. But I think there's going to be other tools that the regulators apply to that problem. So is it going to be portfolio divestment, and you ask banks to reduce their exposure to certain sectors? And then I also think, and one of the things that's going to be really interesting is this process starts in the US, the insurance industry and the reinsurers play a huge role in, particularly on the physical side of risk of mitigating exposure. And I think to the extent that actually the solvency of the insurance companies in the exercises that have been done globally was a really important part of that model. So in the US, where we know the insurers are generally more state regulated and not as directly subject to Federal Reserve or SEC jurisdiction, how are we going to see their balance sheets and their exposure incorporated into the planning exercises? But as those questions get resolved, I definitely think where the regulators identify an individual bank that needs to bring its exposure down, the question of can you hedge or insure or otherwise mitigate that exposure short of just increasing the capital buffer is going to be definitely part of the equation or part of the toolkit.
We hear a lot about greenwashing practices these days, and greenwashing is getting an increasing amount of negative attention, both from regulators as well as the press. Do you see somehow the future of climate stress testing or climate scenario analysis being intertwined with climate disclosure rules?
Yeah, absolutely. And I think, again, that's another data standardization topic, and having clarity and consistency in apples to apples, both how climate friendly certain products or assets or practices are, as well as then what exposure those products create to the banks that hold them or the wealth managers that are invested in them and so forth, is going to be really critical. And I think will build confidence in ESG investing and also give the industry and the regulators more confidence and more certainty regarding what the exposures are. I think things like the forthcoming IFRS standards that individual companies will be required to disclose will help in bringing consistency to how banks analyze their exposure to the companies that they lend to that have provided those disclosures. I also think the other key question there is granularity in the data and granularity in the analysis. So are we doing the scenario analysis at the level of the industry as a whole or different categories of banks? For example, you can look at banks that lend globally versus nationally versus within a particular region are all going to have dramatically different exposures based on how threatened those different regions are, obviously, by things like climate change. And then I think as you get more and more granular and start looking at what is an individual bank's climate risk posture, is that based on the exposure of the sectors that they lend to generally? So oil and gas as a NAICS category, for example. Or are we going to need to start getting into not every oil and gas company obviously is created equal, and some are pivoting towards clean energy faster than others. So do we need to look at our top 10 clients, let's say, their disclosures and their individual exposure and weight that differently? Or do we just say 20% of our portfolio is energy or oil and gas, and that puts us, all else being equal, in a worse position than a comparable bank that has 5% exposure, let's say?
So will disclosure be ultimately sort of, as it becomes more and more standardized, will that essentially, corporate disclosure, become sort of the key piece in the data that'll be necessary to do more had to increase the integrity of modeling in this area, or what type of data do you think is sort of the missing link here? Because in corporate disclosures, it seems like you get a slice, and depending on what's disclosed, but it seems like certainly in other areas of bank stress testing, that you get much more granular in the data than anything that's in the typical corporate disclosures. So, what do you think they're kind of looking for from the bank regulatory point of view, the BCBS point of view, et cetera?
Yeah, great question. And I think it's going to come in layers and have different requirements based on the stakeholder, right? So as you said, the SEC public company requirements, the IFRS standards, et cetera, will be the filer, and ultimately, the client of the bank and or the company that our asset management firms are invested in. So I think that'll be the base layer or the starting point. But as you said, probably will not contain, at least in the initial form. And I think, look at any accounting subject, you start with an initial standard, and requirements get added over time, and more and more detailed and sophisticated and complex. So I think we'll definitely see that scenario play out here as well. And then I think you're going to have what the regulators require individual banks to collect from their clients in order to complete the bank regulatory reporting, or eventually we'll see asset management requirements imposed by the SEC, for example. So that will add a second layer. And then finally, I think we're seeing certain firms among the financial institutions already more advanced than others in doing their own analysis and treating it basically part of the underwriting or credit risk review process. So they'll have a third set of data that I think likely, although this will shrink over time as the other two become more granular, for the time being, those will be both more customized institution by institution, but also probably where you see the more specific data elements that go above and beyond what IFRS or the SEC or the Fed, for example, would require.
Okay. Many bankers and your clients, I think, probably have a sense of whiplash from working on these issues. First the Obama administration that was all in on the Paris Accords, et cetera. The Trump administration, which was kind of all out, and now back to the Biden administration, which again is sort of an all-in approach related to the industry and climate, as well as other ESG topics. Does that inconsistent political environment represent a barrier for firms making long-term investments in these areas? And this is often not the case in our world, but would a better path be for Congress to legislate in this area and have something that's a little more permanent and something that people, that's sort of built to last and can help so you don't see priorities constantly shifting in the regulatory community?
Yeah, absolutely. I think it would be very helpful. And I also think you're exactly right that it's very unlikely, at least in the short term, when you just look at the polarization that we face in DC right now, as well as all the other priorities that Congress is struggling to get to agreement on. I think this, unfortunately for the industry, is further down the list, and it's not likely to happen, certainly in this administration with this Congress right now. The other thing that I would say, though, is that although there is that back and forth every 4 years, let's say, in at least the past 8 years or so, the trend line to me is clearly and permanently up, right? This will become certainly a more critical risk factor. It will get more attention. There will be more requirements, et cetera. And so I think you're going to see some choppiness in the short term, but still, again, long term, permanently moving to the need to do more in this area. And then the other thing that I would say is that, unlike other regulatory areas, I don't think what Congress does or what regulators do is the only input that's going to matter. And you look at the role that the index investment management firms, BlackRock is a great example, are playing in pushing the ESG objectives. And I think even employee focus, right? We're seeing unprecedented turnover right now. We're seeing employees, I think, more so than ever in history, take a much higher degree of interest in the ESG practices of the companies that they work for. And you saw McKinsey, for example, earlier this week, face employee protests about the work that their firm does for oil and gas companies. So that's a trend that's not going to change either. And I think all of those things, again, will continue to put pressure in the system that our clients, the financial institutions, will need to make this a bigger priority. And whether for risk management reasons or their own corporate values and how those will change, need to make this a bigger priority.
So looking then at some of the firm practices, in the absence of specific regulatory requirements, how proactive have SIFMA members been in conducting their own voluntary climate stress tests? And could that, in fact, be publication of a test like that? Could that end up being ultimately kind of a competitive advantage related to climate issues?
Yeah, I think it definitely will, and in a few ways. So one, as you'd expect, I definitely haven't seen that there's a universal or an emerging standard practice across the industry. I think you see a combination of many of the largest, many of the most just inherently, I would say, pro ESG focused institutions that have really made that a priority, again, as a corporate value. And then also, I think some of the institutions that, for example, have footprints that are concentrated in certain geographic regions that are more exposed to immediate physical risks, right? So if I'm a Gulf Coast regional bank, it's every year is a worse and worse hurricane season, it seems like. And so this is a much bigger corporate priority, obviously, for them. And then I think in a similar vein, the banks or the investment management firms that have built a business concentrated on certain industry sectors that are clearly now more climate exposed than they were when that strategy was set 10 or 30 or 50 years ago, obviously are being pushed to refocus or revisit that in a more granular way, I think, than the banks that are more inherently diversified. So those will definitely be factors that I think continue to drive some differences over time. But I also think the trend is clear towards, across the industry, everyone's doing more than they were 5 years ago and trying to get more and richer and more consistent data, trying to make their analyses more granular and more sophisticated. And I think the other trend that we're seeing is a movement towards where, even a couple of years ago, it was more, let's start to measure our exposure and get our arms around this. You're now starting to see, I think, driven both by the likelihood of regulation and by the losses that we've seen in some of the recent disasters that have occurred. Now we're moving beyond just this is a dashboard and we know we have a better feeling about what our exposure is, to we're actually going to start to use this for decision making and actually make the call, either to reprice and require a higher rate of return for some of these asset categories, or maybe we just reduce our exposure and get out of these altogether. And I think you're certainly going to see that trend accelerate as well.
Okay. Well, Michael, thank you again for joining us today. And we also thank the audience for tuning in. To access all of the conversations in the SIFMA Executive Viewpoint series in their entirety, please visit us at sifma.org/annual and click the Watch Now button. So again, thank you very much, Michael, and thank you for our audience. This has been terrific.
Thank you. Really enjoyed the discussion.